Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So today we're just going to do another Velocity Banking review. And I just came back from watching Sonic 3. It's a family, I'm sorry, it's a movie that's fun for the whole family. Remember when Hollywood used to have movies like that? Fun for the whole family. And you know what's amazing about these video game companies is that they really remember their history, just even from 30 years ago. Like, you know how the average person, they can't even remember what they did yesterday? I'm amazed these video game companies remember their history from 30 years ago because I learned something new today. I stopped playing Sonic after Sonic Adventure 1 from the Dreamcast, and the movie Sonic 3 was basically a retelling of Sonic Adventure 2. I had no idea who Shadow the Hedgehog was or who Maria Robotnik was. And I was like, wow, I learned a lot today about Sonic's history. And so, what we're going to do is use Sonic as an excuse to pay off debt fast. Because remember the slogan, "Got to go fast." That's what we're going to do today. And to start off, we're going to go ahead and ask ChatGPT, can we describe velocity banking in the voice of Sonic the Hedgehog? So let's go ahead and do that.
Sure. Here's Sonic explaining velocity banking. Yo, dudes and dudettes. Sonic here, and I'm about to blow your minds faster than I can run through Green Hill Zone. Let me tell you about velocity banking. It's like turbo boosting your finances to get out of debt at lightning speed. All right, so here's the deal. Instead of plodding along with boring, slow as molasses monthly payments, you use a HELOC or a home equity line of credit to supercharge your cash flow. Picture this: you take a chunk of your income, zap it straight to the principal on your mortgage or other debt, and bam, you're shaving years off the timeline. The key is managing your expenses wisely. No wasting rings on stuff you don't need. You got to keep track of your budget, like I keep track of my Chaos Emeralds. Then you keep cycling your income through that HELOC, which acts like your financial power up. Less interest, faster payoff, and you're speeding toward financial freedom. So grab a chili dog, stay focused, and remember, with Velocity Banking, you're always ahead of the game. Got to go fast, especially when it comes to beating debt. What do you think?
Yep, gotta go fast. And this is what we're going to do. We're going to play the Sonic theme song right here. So, we're going to play it twice. We're going to play it right now. And then once we defeat all of that, we're going to play it as well. So let's go ahead and play it. Yeah, y'all hear that? That's the theme song that plays when you pay off debt quickly, okay? All right. So let's go ahead and get started. Yeah, so velocity banking, what is it? It's just paying off debt quickly with a really cool theme song that you just heard. All you need to do for velocity banking is two things. Number one is a budget, and then number two is have a line of credit and use it as your main operating account, right? I wrote that somewhere right here as a budget. And then number two, line of credit is your main operating account. So we have a budget here. This is a scenario that I did last time, but you know what? I figure why not just do it again? Remember that Bruce Lee quote just about doing things over and over again? And he talked about you just do one kick 10,000 times. I fear the man who does one kick 10,000 times rather than, 10,000 kicks once. You know why so many people are so bad at what they do? They just do 10,000 kicks once. They just have experiences that are very shallow, very, not so deep, but that's what we do is that we become masters at our craft, right? A lot of people complain like, well, you just do the same thing over and over again. I'm like, duh, because I listen to Bruce Lee, you know what I mean? And I'm awesome because I like to watch Sonic the Hedgehog as well. That's another thing, but it's not really related to what I'm talking about. Anyways, all right, so we have our budget. We're gonna do a high income scenario, right? And here we have we'll say a couple that makes $290,000 gross. So that's about 16 grand a month. And you might be thinking, hey, um, if I made that much money, I would not be in debt, right? You ever hear people say that when they're poor? Folks, people who are not prepared when they're poor, they're gonna have a hard time when they make a lot of money as well. That's why certain groups of people who don't have financial literacy, and again, it's not their fault necessarily, but it's just the way that the system is, become broke within a few years. I can think of one group, mainly lottery winners, who are like, have a lot of money, and then they essentially end up dead within 3 years, right? Isn't that the joke? Or 5 years? Like they either end up dead or broke. Same thing with pro athletes, right? Like the average, I think NFL lifespan or career is about 3 years, I think, 3 or 4, and then they become really broke after they, retire, within their career because it's brutal, like, physically demanding on your body, right? It's very physically demanding, and then they just become broke, right? They just become broke. Again, it's not always about just the money, it's about how you handle the money, okay? And that's what we're talking about with velocity banking, like, a lot of people, the reason why they're broke when they make good money is because a lot of it is just debt. It's kind of like with real estate. You ever like admire like other people who have real estate? It's like, whoa, that dude's a landlord. Like that person must be rich, and then they're broke because a lot of it is just debt payments to the bank. The bank is the ultimate winner. Ever heard the term "be the bank, not the landlord"? That's something that you really have to really think about. Why they have the tallest buildings in North America. Okay. So here's what we know about this person. We have this good income, but we got a lot of expenses, and we only have $2,000 of savings left over. Now, most people, if they made this type of income and only have $2,000 left over in savings, they'd be quite ashamed. And why do they have such little savings? It's because they got so much debt. Look at this: one, two, three, four, five, six, seven, eight, nine, 10, 10 credit cards, two auto loans, two law school loans, and a mortgage, right? So we got a ton of debt. And then we have our expenses that we always have to pay for every single month: food, gas, insurance, all that good stuff. That's not debt. So this will always stay the same. But all of these other debts will potentially, these payments may go to zero if we focus on paying them off first. Okay. So with velocity banking, there's going to be two assumptions. Number one is that we don't have an increase in income. Even though an increase in income is great, you start a YouTube channel, oh, you could be making a couple $100 more, to thousands of dollars more, if you know what you're doing, right? I'm making 3 to 500 a month with this channel. All I do is just talk. It makes the spreadsheets, and people are watching. Hey, people are watching, right? They're watching from a distance because they're like, what? Nobody told me this. And then we got our few hardcore followers that are always watching, always commenting, always liking. But your average person looks at this and it's like, what? Why aren't they teach me this in school? It's like, well, you know, the powers that be, and I don't know if you're like watch these old George Carlin videos. Um, don't want you. They want you to be smart enough to do the paperwork, but not that smart enough to figure out what's going on. Right? That's that old George Carlin joke. Anyways, same income. Now with our savings, we're gonna do what I call putting our big boy pants on, which is doing the opposite of what society teaches you, right? So society teaches you that hey, you need 3 to 6 months of savings, especially in your expenses. Um, and especially if you're broke, try to save $1,000, right? Well, this person can save $1,000, but we're gonna do the exact opposite of that, which is not have any savings. Not have any savings, right? Now we have the same expenses, but okay, we're going to have something called cash flow, even though we don't have savings, right? And our whole goal from the very beginning is to increase this cash flow number as much as possible. Okay. And so if you take a look here, scroll up, money at the beginning of my checking account should be zero. This is my checking account, and the end should stay zero. That's just how it is, right? So a lot of people freak out about that. You tell your average person, hey, I don't save money at all. There's nothing in my savings account after every single month because My money doesn't stay in my checking account. It's either actively investing or it's actively paying off debt. And so whenever I see some money in my checking account, let's say $2,000, I feel a little bit uneasy about that. That's the whole point of this number right here. Whoopsie. Where'd I go? This number right here being 0, the savings number, and we're gonna increase our cash flow, okay? Now, the second assumption that we're gonna make is we're gonna have access to a line of credit. Let's say $200,000, and I know what some of you are thinking. Some of you have never seen this for the first time. Again, put your big boy pants on, are thinking, "Well, who would lend you that much money? Oh my goodness." Well, first of all, we have to know how banking works. And I got to repeat this over and over again because I always get comments about, well, who would do that, right? And that's not realistic. Listen, um, you see this right here? I call it the Infinity Gauntlet, right? The Infinity Gauntlet. I got a free and clear $280,000 line of credit. I took the screenshot um 30 minutes ago. It's actually a home equity line of credit. Here's another screenshot of this home equity line of credit. Previous screenshot, and then now I got a free and clear Infinity Gauntlet home equity line of credit, $280,000 limit, 7.75% interest rate, and you're coming to my channel and telling me what's possible or not. Man, I feel like it's been a long time since I've watched it. Was it The Godfather where it's like you come to my house and you diss me? I don't think that's the line, but it's the feeling that you're giving me. I don't know what I'm talking about. And I gotta do that finger thing, that Italian mobster finger thing. Because this is, in addition to being a cult, this is a mob as well. It's a mafia. That's what it is, right? No, I'm just kidding. It's not that, but but a lot of people sometimes, or not a lot of people. Sometimes people come to this channel. Well, who's gonna lend you a line of credit? And I'm like, bro, it's because I know what the banks are looking for. Okay, here's the thing about banks. They don't lend money to people who need it. And this is a shock to most people, right? Because every time you see bank marketing and bank advertising, what do you see? Oh, we're going to be there for you, right? And so it kind of lulls the person, the average person to sleep where they actually think when they need money, the bank will be there for them. No, no, no. The bank just lies to you when they tell you that. They don't lend money to people who need it. And so here, okay, this is almost kind of like a warning, right? Oh, wait, is this the right one? This is kind of like a warning, right? See, if you actually learn velocity banking before you ever get into debt, it's almost like ensuring you never get here. But the people who have access to lines of credit, what usually happens is that they just treat it like another credit card and it's just another maxed out credit card for them. Okay. So, but let's just assume that we have a free and clear line of credit, $200,000, right? And we got it when we did not need it. But for most people, because they're not active in their finances or proactive, they always try to get it when they need it. And we cannot do that. Banks don't lend money to people who need it. They don't. Okay. So let's go ahead and do this. And all right. Let's just do this. So what we're gonna do is move some debt and move it to the line of credit, and just as a shortcut cheat code, you usually start off with the short-term loans or credit or high interest rate credit cards. So we got 10 of these. So this is $167,000 of credit card debt. And then let's go ahead and move it. So this is going to be 167000. And then now this is just all going to be 0, 0, 0, 0, 0, 0, 0, 0. And now, look at this. Our savings went from $2,000 to $7,366 of cash flow. And then what you do is you put your entire paycheck into the line of credit, the 16 grand, and then you take your expenses out. And then this cash flow number is the debt, the balance of our debt that's going to be reduced every single month before the interest that accumulates in the line of credit. Okay. And so again, I don't fear borrowing money because here's the thing. Even though people freak out, that's a 7% interest rate. So look at this. At one time, I borrowed above 10 grand in my line of credit. And then this is the screenshot from today from what I call the Infinity Gauntlet. I only paid about $200 of interest in total. Okay, if you know what you're doing, it's like the interest is not a big deal. You see what I'm saying? So, you could just fear monger me and tell me, "Aren't you worried about this?" And again, for some people they have to be, but the bank, they usually when they lend you money, they see that it's at a level, you make a level of income that shouldn't be a risk to them, is what I'm saying. And so you also have to think about the bank's ideal client is they want people who make money, but they're kind of bad at managing it. Like it's like this sweet spot, like Goldilocks, right? Like they don't want you to be so good with money that you pay them off so quickly, and then they don't want you to be so bad with money that you're gonna pay them late. Okay, it's just monthly payments over time, whether it's credit cards or loans. It's just what they want. Okay, all right, so now let's go ahead and do the calculation. All right, all right, okay. So the formula for calculating the next month's balance is the previous month's balance plus the previous month's interest minus this cash flow number right here. And then what we do is we take the interest, right? What we do is we take the average daily balance, multiply it by the interest rate. So this will be 0.08 and divide by 12. I've had HELOCs that were at 10%. This HELOC, when I originally signed for it, was at 8%, but take a look here. 7.75, right? It's amazing. Okay. So now what we do is just copy and paste home equity line of credit. And you might be like, do I need a home to do this? No, it's just if you offer collateral, you get better terms and rates, but you can get an unsecured personal line of credit. You just probably won't get the best terms and rates. Okay, so 25 months to pay off 167,000 in lines of credit. Okay, you see how easy that was? Holy balls, that was so easy that I just can't believe it. Okay, I just can't believe it. Right? Gotta go fast. All right. And actually, let me go ahead and play that Sonic Victory theme song because this is worthy of the theme song. Yeah. Okay. So let's just do it one more time. And now, oh, did I even set up the loan calculator correctly? It's okay. It's okay. It doesn't matter. I'll just set it up right now. So let's just go ahead and do this. All right. So again, I'm gonna zip through this, but usually when I have loans, all you gotta do is just have three things to figure out the monthly payment, which is the original balance, the interest rate, and the loan term. I'm just gonna go through this really quickly. All right, so 6%, 5.4, and then all right, so 5.5. So this is gonna be how long is law school loans? 10 years and mortgages 30. All right, we got it. Okay, cool. And so now what current month are we on with our loans? We're at month 25. All right. So now we're going to go ahead and do this and move these two loans into the line of credit. Why? Long story short, we have these low cash flow index numbers, and whenever we have low cash flow indexes, and if you don't know what that is, look it up in Google. It's okay to move those into the line of credit because we get more bang for our buck in terms of cash flow. All right, so 37,513. Okay, 37,513. Yeah, so we're gonna move this into that line of credit, 37513.83. And guess what happens here when we do that? Well, these two go to zero, and then we get an extra $1,000 in our cash flow. Whoa. Right? Remember Keanu in The Matrix? Whoa. I can dodge bullets. When you're done, you won't have to, right? And Keanu was Shadow the Hedgehog. All right, so let's go ahead and copy and paste this. And this is month 30, right? Month 30. Okay, so 30 months. And then we paid off an extra $60,000. So 167 plus 60, 227K. And then let's go here, 30 months. So this is 0, 0, 30, 30, 30. And we take a look at these law school loans and then, oh, okay. Um, Again, think of this as a ranking system of debt payoff orders. So you want to start off with the lowest ones first. And if we have a cash flow index above 50, probably best to use the chunking method, which is just paying it off incrementally. Um, well, I don't want to say probably. It is the best, I think, but I don't want to say that for sure, unless someone's figured out something that I haven't. All right, so here's the thing: if we have a 6% interest rate, that's lower than 8. Now, here's the thing: if the interest rate is same or higher, I'm always comfortable putting that debt into a line of credit. But when it's lower, we got to be a little bit careful. And if you ever just do kind of comparisons with moving a low interest rate loan into a high interest rate line of credit, again, always look at this cash flow index number and do the math, because you'll see that it's not worth it to replace a low interest rate mortgage with a line of credit. A lot of people fall into this trap because a lot of people on the internet promote it, but they don't really they just kind of skip over the math. It's kind of bad. But let's go ahead and open up what we call the velocity banking calculator. Give me one moment. All right, we got the velocity banking calculator by Renatus, right? So just a quick plug. Um, I know you all love velocity banking, right? But did you know, okay, I don't know if you knew this or not, that there's more things to learn in addition to velocity banking, like learning how to buy real estate at a discount and all this other cool stuff. So if you're one of the very, I'll say, chosen few interested in upping up your game, click the Google Form link below, book a call with me, and I'll talk to you about that. Okay. Just a quick plug for Renatus, which is where I originally learned velocity banking from. All right. And so now I just put this calculator in, and let me just do this. Whoopsie. 16000. All right. So now here we go. It'll take us about 1.1 years to pay it off. Wow, amazing. Okay, 1.1 years. So let me just go in here and then just type it in. So you 30 plus 12 times 1.1, and that's about 40, we'll say 44 months, okay? 44 months, which is let me do this. 227 plus 160, so that's 387K. All right, now we just go on to the next one, which is this is 0 now. And so in 44 months, what's the balance of the loan? So this is 44, 44, 0, okay. 90 grand for this one. So we'll just kind of plug in the numbers here. So this is going to be, we'll just redo this again. This one here. And let's just try this one again. 10. And let me go here. 130 is the original balance. What's the current balance? 90227.52. The interest rate is 5.4%. And the payoff amount is 1404.41. Or not the payoff amount, 14 payment amount, 0.41. And then what's the expenses? Okay, well, the expenses is everything except for the loan we're trying to pay off. So it would be this number here, 4264.81. 4264. All right, so 0.7. 0.7. Okay, so let's go ahead and do that. And so now it's 44 plus 0.7 times 12. So that'll be about 53 months. Let's say 53 months. And then this goes to 0. And then so it's 387 plus 130. So it's 517K. All right. 300,000 at 3%. 300,000 at 3%. So 53 months. Okay, now I just got to copy this. All right, so now one more time. Okay, one more time. So 300,000. 270,863.64. 270,863.64. 3% interest rate, 30 years. 1264.81. And what's our monthly income? 16,000. And then what's our living expenses? It's just everything except for this one. So now it's 3,000. All right, so now 3,000. 1.8 years. Take a look at this. 1.8 years and how much interest we were gonna pay versus what we actually paid, which is about 8 grand. 117 grand versus 8 grand. Which one do you want to pick? I'll pick the 8 grand, right? And I'll pay it 1.8 year. Folks, is this even real? 1.8 years? I must have done something wrong, right? Because it just seems way too quick, right? But because it's way too quick, now we gotta put the Sonic theme song to good use again, and I'll play it one more time. Gotta go fast. When did Sonic start eating chili dogs? I don't even remember. I think that was a little bit beyond my time, but there was a point where for some reason his favorite food was chili dogs, and I don't really get that, but it's okay. Alright. So 1.8 years. So now 53 divided by 12 plus 1.8. How long is that? How long is that? Oh, 6.22 years to be debt free. Again, you ever watch those videos where it's like, oh, you could be mortgage free in 7 to 10 years? No, 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 no. We're mortgage free when we actually focus on paying off the mortgage in about 1.8 years. Okay. 1.8. We're completely debt free in about 6.22. Okay. 6.22. So, folks, got to pay off debt fast. Gotta go fast. I paid off my mortgage in about 2 years and 9 months. And again, you might not believe me. It's a screenshot right here, and screenshot of my home equity line of credit at 0. Um, I don't know what to say. Like, I really don't. Like, people come to my channels like telling me what's real, what's not. They're like, this all can't be real. And it's like, bro, like, all right, well, tell me with that when I was like broke and poor and nobody helped me. So, just so that I never have to go through that again. You learn a few things here and there, and you go through some life experiences here and there. But most people don't want to go through that, and so they just become stuck because what happens in our society is that we live in a society that essentially shames you for learning things that you were never taught because like what what you didn't know, of course I knew that. And it's like, all right, whatever, bro. Like, that's what people do because they got too much ego and pride. And I don't even know where that comes from. I've never really had that much of a big ego in my life because, it doesn't make sense to be prideful when you're drowning. But history has told us that this has been the case for a long time. Remember the Titanic? Remember how, like, the people in the Titanic were told the ship was going to sink? And they just, like, kinda didn't care, and they got angry. It's like, "Well, don't tell me the ship is gonna sink," right? Like, that's how a lot of people are. That's why I don't try to save them because a lot of people are, like, in the Titanic. That's what it is. Human nature, but that's what people wanna do. Now, anyways, let's just play that Sonic theme song one more time. Yeah! You hear that? That's your new theme song when you pay off debt this quickly. 1.8 years to pay off a mortgage. All right. Well, this is Korean Atlanta Mentorship. Have a great day, and we will speak next time.